A report by one of the big four banks reveals a lot around where we are fundamentally in the property market when it comes to first home buyers. And then as well as that, I'm going to look through another investor report which shows the investor activity in the market right now. So we establish what's happening in the foundation of the market when it comes to property prices. And as well as that, we're going to look at what this means for the next 18 to 24 months. If you're interested in what my thoughts are, definitely keep watching. Hey guys, my name is Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, personal development, and all things financial freedom. Let's go through the first home buyer report, look at some really key insights, and then draw all of those conclusions right at the end. That's the stuff that you love, the summary that I make. What we have here is a report by PropTrack and Commonwealth Bank. It's the first home buyer report. Now, I'm not going to go through each and every point in this report, but I'm just going to highlight some really key things that we need to take away from it. So first home buyers are facing challenging conditions. Saving for a deposit takes longer than it did for previous generations for first home buyers. And with the rapid rise of interest rates in 22 and 23, mortgage serviceability is at levels last seen 3 decades ago. Since then, we've had 3 rate cuts as well, so that's starting to improve. Even so, there were more first home buyers in the past year than was typical during the 2010s, indicating that first home buyers are finding ways to buy despite these challenges. Now, a lot of the reason why they can get into the market is through government intervention. I'm going to draw on exactly what that means in a second. Taking advantage of government grants, low deposit schemes, and lenders' mortgage insurance can enable first home buyers to overcome the deposit hurdle and buy sooner. Buying newly built or rent vesting are also strategies some are implementing to overcome challenging affordability. I definitely wouldn't be looking at buying something completely new. Again, it really does depend on where you want to live, how you actually want to do this. If you're just buying a place to live in, you're putting a lot of money at stake here in the hope that the property actually goes up. So that's why you've got to be very careful with what you buy as a first home buyer or any time buyer really. Having flexibility on location and the type of dwelling can also provide opportunity for first home buyers. These buyers typically look at more affordable suburbs and at apartments to make the most of their mortgage serviceability. The good news for first home buyers is that mortgage rates are falling and are currently expected to decrease further across this year. While home prices are rising, lower mortgage rates will help put more homes within the reach of first home buyers. Now, one of the biggest schemes that got released was meant to come out on the 1st of Jan 26, came out on the 1st of October 25, and we've already seen carnage in the marketplace. We've seen property prices starting to really pump up, a lot more buyer activity as well. And the way that the first home buyers scheme is actually marketed is it's very good for first home buyers. While it does mean they need a lower deposit without having to pay lenders mortgage insurance, the big problem is that it's now causing prices to go much higher a lot quicker, which means your servicing needs to be higher so you can actually afford to buy a property that's more expensive, but also your deposit needs to continue rising because the market's moving faster than you can save. What we can see is a steady incline in terms of higher highs and in terms of higher lows when it comes to this graph here, since 2017 when it comes to the number of first home buyer loans. So despite the difficult rental market conditions, likely encouraging capable renters to move into home ownership sooner than they might have otherwise. So obviously as your rents increase, it's harder to save a lot more. And obviously if you're wanting to go and buy a property, it's a lot harder. Well, we can see a massive spikes, and every time we've seen those spikes is because we've seen something artificially has happened in the market for it to be actually spiking like that. Post 2008, 2009, we obviously had the GFC. Property prices did calm down at that point for a little bit, but you also had the government come out and pump a lot of money into the system. You saw a very similar thing with interest rates popping down in 2020, 2021, and now we're starting to see that incline. But what's really interesting is how many people today are purchasing property with 20% deposit versus a 10% deposit. And the key reason is that 20% deposit is a typical target for many buyers, but it is increasing as to how long it's taking to go out there and buy property with a 20% deposit. So if you want to purchase a median house in Australia, it takes now on average about 6 to 7 years to go out there and buy property with a 20% deposit, which is why we see schemes coming out which are really supporting first home buyers when it comes to 5% deposits and 10% deposits. If you can get into the market with a 10% deposit, it then means that we need half of what we need right now. So that means it takes about 3 years to get into the market. So something I've been paying attention to is how this graph is always up to the right. But what's more important is that if we can now halve the entry barrier to get into the market because we needed a 20% deposit versus a 10% deposit, then it means effectively we could get into the market in about 3 years. Now, something that is very speculative and also very controversial is that then we have much further to go. Because you can then see if it takes 6 years to actually get into a property because you only could use a 20% deposit in the past, and now you need 10 years, then it means that effectively we're at levels here that we haven't seen since pretty much 2000, which is about 25 years ago. Now, the data from the Reserve Bank of Australia shows that nearly 3/4 of first home buyers are now purchasing with a deposit smaller than 20%. We can see this here with the first home buyer loans by LVR. You can see hardly anyone's purchasing a property with less than 60% as the LVR, but what you can see is it's very popular at about 90%. There's still quite a few people using a 20% deposit to buy property, and I suspect that's a lack of knowledge, because you could effectively go out there, go in, pay a 10% deposit, use the other 10% as just a buffer that sits in your bank account, and that would then be one of the ways I would go out and protect myself from the downside. So if I had 20%, rather than putting 20% into that property, I would go and have that sit in an offset account, or at least a portion of that, and that becomes my emergency fund. If you go ahead and you just use all of your money in that property, what happens if you lose your job? For a temporary period of time, there's income volatility. Does that mean you have to sell the house, or you let go of lifestyle? That's not something I'm comfortable with. Now, I have spoken about the home guarantee scheme, which has come out on the 1st of October and what it's already doing to the market. Definitely go check out this video. It talks about how this is going to affect the market, how it's going to affect property prices, and if you're in the market to either rent or buy, it's definitely going to have some massive ramifications. You have a bunch of stamp duty concessions also helping first home buyers get into the market. And what's really interesting is the mortgage repayments as a share of income. So here's the national average income household against median priced homes. And what we can see is the mortgage repayments as a share of income really has started to top out here, but it's at levels that we haven't really seen since 1990s, which is actually very scary. It means that a lot of people are having to use a higher portion of their income towards going and paying their mortgage repayments. And now we're above levels of 30%, which traditionally has been deemed as unaffordable, and it's very difficult. It's the same thing when it comes to the rental market. A lot of people are spending anywhere between 40 and 60% of their income just to rent a place, which is absolutely crazy. Now, PropTrack also came out with a report when it comes to investors. Now, a lot of people that watch the channel are investors looking to scale up their property portfolio. If you're someone there that wants to get finances sorted, I'm going to leave a link in the description box below to Refine Loans. They know how structuring works when it comes to trusts, unlocking unlimited borrowing capacity. Yes, you can do it, and you should definitely check out this whiteboard video after this video, because it's going to blow your mind. But if you already have finance sorted and just want to find property and get into the market, then definitely book in a free call, which I'll also leave a link in the description box below for. Now, investors are a large and important part of the Australia's property market. About 1 in 7 Australians now own a rental property. Investor activity has been strong in the past year, with investors making up around their highest share of new lending since 2017. This high level of activity is likely driven by falling mortgage rates and tight rental market conditions. Underscoring how tight rental market conditions are, rental vacancy rates are very low by historical standards. In some cases, they're at all-time lows. There is a strong competition for rentals, rapid growth in rents, and increased gross rental yields. It's very important when you're purchasing property not just to look at the capital growth element, but also the rental growth. If you're an investor, you need to know what it looks like from an income perspective, because that's going to determine how long you can stay in the game. What I've mentioned on the channel before for the last couple of years is capital growth gets you out of the game and cash flow keeps you in the game. What I mean by that is if you don't have good cash flow, you can't manage that cash flow with maybe neutral or slightly negative cash flow. It means that you can only ever hold 1 or 2 properties at the very max. And if something happens to your own income, then you're going to have to start offloading those assets. And as we know, real estate is the long game. Now, how many people have rental properties? The share of taxpayers reporting gross rent, according to this, is around 15%. I suppose this number dropping here is due to the fact that interest rates was starting to drop, and also a lot of investors started selling property because they were scared, but we also did see a lot more come through in the market in the last couple of years. Now, if you look at the number of investment properties owned, share of household that owns a second home, you can see that there's only 4.3% of households that own 4 or more properties. Something to take note of, you see a bunch of people online talking about how they've got property portfolios, 10 properties, 20 properties, 100 properties. You need to know that there's only less than 4.3% of households that actually own 4 or more. So you might be doing better than you expect. And I found this one really interesting as well, which is investment property ownership by age. What you can see is the lowest amount between 15 and 24%. It's about 2 to 3% based on this. You can see this number increase to about 12% for 25 to 34-year-olds, but the majority of people that own investment properties are between 35 and 64. And that's absolutely wild, especially if you're young, you're watching this channel. We've helped many clients get into property before the age of 30, which is really cool, and I'm very proud of that. A lot of people think that, oh, you're getting into property, you're getting a lot of this debt. But the reality is, like, you're living in Australia and the system is absolutely against you. When the currency continues losing its value, inflation is absolutely rapid. and there's no other solution. So you have to go out and attach that money to hard assets. A lot of people like real estate because it's something that you can touch and feel, whereas someone might be really skeptical to get into things like Bitcoin. As I've mentioned before, there's two things at play here: supply and demand when it comes to the property market and where prices are headed. So one thing you need to look at from the demand side is how much availability of credit do I have? Because effectively, if the bank is going out there and giving you more money, so if you go out there and say, hey, actually I need a loan, where did they get the money from? They created it, right? So if that's more creation of money in the system, it means the market is expanding, and that is what causes prices to go high. So new investor loans, what we can see is we're starting to edge a lot higher since 2023. And even if you want to go back to 2020, where we were around levels of about 25,000 nationally, we're now closer to about 50,000 nationally. So about 2x the amount of investor loans that are going out now versus back then. And I suspect a lot of this is due to the fact that a lot of investors had purchased really well. They've got really good equity. They're now using the equity to go and purchase another property and scale up their portfolio even faster. And the other part to this as well is that there are so many ways that you can structure out your portfolio that allows you the flexibility to continue building the wealth in real estate versus previously that knowledge wasn't really available. In fact, I only started the channel in Feb of 2020. Just so coincides with this increase in the low that we saw there. Maybe there's a lot more investors here because they watch my channel. So based on all of this information, based on the reports that we're getting, what does this actually mean? And that's where I come in and I can give you my 2 cents. Because not only am I an investor in this market and I've been investing for about 12 years, but I also happen to run one of the fastest growing buyers agencies. We speak to about 200 to 300 people every single week. And that's volume that allows us to start creating some trends, understand what's happening in the market, look at consumer sentiment, and it gets us a lot more data because we're active in the market, we're going out purchasing a lot more property, and we're having to do due diligence and a lot of data breakdown as well as research into new areas because we're forced to. So with all of that information and the stuff that I've presented here on this video, it's fairly clear and it's very obvious that we're gonna have a position where it's so much harder in 5 years to actually purchase property. And I think it's not only just buying property for yourself, I think just the thought of having an investment property is gonna go out the window. I think the people that have gone out there and purchased property well, I could totally see a world in which in say 5 or 10 years, we could have the government come out and say, actually, we're gonna cap how many investment properties an individual could have. The other thing that we could also have is the banks could come out and say, okay, we're gonna have a different set of rules when it comes to lending to investors and a different set of rules when it comes to first home buyers. We've already seen that, so there's no surprise there. But I think we're gonna see the next level of that. And what that could look like, and I've brainstormed that with my team members as well, is it could potentially look like not just interest rates being more favorable towards first home buyers, which we've already seen. The other thing that you would have noticed back then was that fixed rates were a lot lower. So the next level to that could be that your borrowing capacity is significantly reduced when you're going out and buying property as an investment. Maybe it's the 4th investment or the 5th investment property, or you could just have that increase in terms of the rental shading. And this is why it's so important as an investor that's scaling up a portfolio to talk to the right people when it comes to brokers. Because the majority of brokers, they deal with people, the mum and dads that go out there and buy property for themselves. But if you're going out and scaling up a portfolio, you need to understand the bank's policies when it comes to like rental shading and bonuses. Because there are some banks that go, okay, well, you're earning rental income, but I can only take 80% of that. Or they might say, hey, actually, we can take 100% because last week we were taking 80%, now we're doing 100% because we've got more of an appetite. Imagine having that key information available to you. That's going to allow you to then operate like the 1%. Because you have inside information, but really you're just aligning yourself with the right broker. Either way, it's really scary when it comes to home ownership, especially because the shortage that we have in new houses being developed, new houses being approved is increasing, but the completions are nowhere near where they need to be. We've got interest rates also falling, you've got government schemes coming out, and Louis Christopher from SQM Research has suggested that if we have the first home buyer scheme go out in the way that he thinks it will, we could see prices rise by 15 to 18% over the next 12 to 18 months, which is pretty crazy because for first home buyers or investors, for both really, you're behind the 8 ball and you continue to just try and grind to get ahead. Because assets are moving higher than your income, it's actually putting you at a significant disadvantage. So it is pretty bleak times ahead. I still think we have this window, a unique opportunity for people that are still scared, but can really push and take on risk. Because reality is, if you're living life without risk, unfortunately that will be the biggest risk, because it will keep you in what is the middle class today, but it will eventually lead to the collapse. And then unfortunately you're relying on the government to dictate what you can and can't do, or you'd have to move out of Australia, which is pretty crazy, but I think that's where the world's headed. I definitely think there are solutions on the horizon, but I don't think they're coming anytime soon. So if you have enjoyed this video, I'd love to get your thoughts as well. Let me know in the comments down below. And if you have enjoyed this, subscribe to the channel, check out the other videos that I've mentioned, and I'll catch you guys in the next one. Thanks, guys.